All right, we are live again tonight. Another day and another bailout. I wish this ended. This is the nightmare that will not go away. Just like the coronavirus outbreak, how it's still ongoing. Okay, so for those of you who did not pay attention to what happened today, first we had bad jobs numbers. So in the span of 3 weeks now, the jobless claims, 16 million adult Americans have now filed for jobless claims or unemployment checks at the state levels. So I still do not think that this is the real number. I saw someone who tallied it up going around Twitter, a financial professional using a pseudonym, that the real unemployment rate would be around 14% now. But hedge fund managers like David Tepper and others, and also people at the former people at the Federal Reserve and current people at the Federal Reserve, expect the real unemployment rate to go to at least 20%. It may end up a lot higher than that in the not too distant future, probably over 30%, depending upon how long this goes on for. Meanwhile, as I talked about in a recent show, the Fed's balance sheet is going parabolic. Where is it looks like a hockey stick there, as you can see, almost like a hockey stick, skin close, as you can see there on your screen. Where is the Fed's balance sheet going?
To infinity and beyond!
Yep, that's where the Fed's balance sheet is going, to infinity and beyond. Just completely and totally crazy, as normal. Okay, so the Fed's balance sheet, let's do some numbers here. Okay, let me pull up the stuff in my calculator. The Fed's balance sheet has gone up since the end of August 2019, when quantitative tightening ended. The Fed's balance sheet, official balance sheet, is now up $2.323195 trillion. Wow. So, but the majority of the move has occurred in just really the last couple months. Let's see here. Last 43 days, I think it's up since the end of Wednesday, February 26th. The Fed's official balance sheet was at $4.158 trillion, so almost a $2 trillion increase in under 2 months. Yep. Wow. Nuts. And it's just getting started, because the economy is not restarted. Tax revenues are not being collected on normal economic activity and normal business activity. So if you're a consumer and you're going to bars or restaurants or you're going shopping, those shops, restaurants, bars are not collecting sales taxes for your state and local governments. So those budget shortfalls, the Fed is going to have to bail them out too. So just crazy. In spite of this, the dollar index actually has not crashed. The dollar index is still, it was, I think, above 100 earlier today. It's a little bit below 100 now. It's at 99.58. So the Fed may start to panic if it continues to buy up, makes all these announcements for more trillions and trillions of dollars of commitments, and the dollar index doesn't get weaker, because the Fed wants a weaker dollar. President Trump wants a weaker dollar. The Trump administration wants a weaker dollar. The U.S. Treasury wants a weaker dollar. Well, maybe if President Trump does this. So this was at today's news conference with their coronavirus update stuff, where they talk about the economy. They talk about their modeling for how many people are infected and the normal routine. So let me play this clip here for Trump. It's 31 seconds long. It's from Breaking 911. They cut it down into a 31-second clip. It's about student loan debts.
Today, the Department of Education is also announcing the availability of more than $6 billion in emergency grant funding to assist college students impacted by the cancellation of classes and the suspension of housing. A lot of people had a lot of things suspended. Housing is one of them. Previously, we waived student loan payments for 6 months. So student loan payments have been waived for 6 months. So we'll discuss it after that.
Okay, so he talked about waiving student loan debt payments for at least 6 months and maybe even longer than that. So that means they're already probably discussing, and I've been predicting this for at least a couple weeks now, that the Fed is really desperate to devalue the dollar. They're willing to buy almost any asset. So what did the Fed actually commit to buying today? So Zero Hedge put out an article that free markets are dead, Fed to start buying junk bond yields, high yield ETFs. There was also a more in-depth article that I'll talk about after this one. So back on March 23rd, the Fed unveiled it would start buying investment-grade corporate bonds. We said now that the Fed is effectively all in, it will buy stocks and junk bonds next. 2 weeks later, we were right, and this morning the Fed announced it would, as expected, start buying junk bonds. We have to wait for the next market. We use the term loosely. Yes, no, it's no longer a market. I mean, they're bailing out rich hedge fund managers and billionaires and corporate CEOs. It's not a market anymore. Well, not really. I mean, you could trade at the casino, but it's not a real market because they're not allowing bankruptcy. Capitalism involves failure. Capitalism involves bankruptcy. We use the term loosely because it is no longer a market which is terminally disconnected from fundamentals, but a giant Fed-fueled Ponzi scheme crashed before the Fed goes literally all in and starts buying stocks and pretty much anything else. But let's back that up. A few days ago, pointed out that the day so many credit bears had been waiting for had arrived when a record $150 billion in investment-grade corporate bonds were downgraded to junk, becoming so-called fallen angels and sparking concerns about what will happen to the $1.3 trillion junk bond market as hundreds of billions of formerly investment-grade debt is downgraded to junk and violently reprices the entire high-yield space. So this is the vortex doom loop that I've been talking about, where pension funds and professional hedge fund managers that were doing the different types of trades, either the risk parity trade or the basis trade within treasuries, where especially pension funds, because pension funds cannot, some of the pension funds in their bylaws cannot hold below investment grade bonds. So that means they have to immediately sell. So some pension funds, it's like that with dividend stocks. If a dividend is eliminated, some pension funds in their bylaws have to dump the dividend stock, and then that creates a vicious cycle. Or a stock that ends up going to $5 or less, some pension funds cannot hold that stock anymore. So this would be the case where those investment grade corporate bonds getting downgraded, those pension funds are going to be dumping. And 4 or 5 weeks ago now, since I've been covering this for a couple weeks, some of these bonds, actually a good chunk of these bonds, whether it was leverage loans, it was investment grade corporate bonds, some high yield bonds, they went no bid because you had hedge funds that were blowing up and being liquidated and needed bailouts. I covered that topic recently in the last couple days more extensively. And so the Fed had to come in and buy those things, but eventually the Fed at the time had not committed to buying junk bonds yet, but pretty much everyone, once they did that a couple weeks ago, pretty much everyone figured that they would eventually commit to buying junk bonds because we knew, I was warning you guys about the credit ratings downgrades that were coming because all those investment grade corporate bonds, the cash flows from those companies that they were relying on in a normal pre-coronavirus economic activity, those cash flows are, some of them, we're going to find out the Q1 numbers for the first quarter. We're going to start finding those out. Levi's announced, I think, on Monday, their earnings on Monday. We're going to start finding out some really bad numbers from some of these corporations. They're going to be brutal. They're going to be as brutal as the jobs numbers we have. We're now 16 million Americans in only 3 weeks. And I think that number could still go substantially higher. But don't worry, the stock market will still go up. Not on fundamentals, though. I mean, they'll be talking heads on CNBC and Bloomberg grasping at straws, claiming that it was fundamentals for why the stock market's rising. The bear market is over. If you played a drinking game with the phrase, the bear market is over, you would be drunk after about 5 minutes. How many times I've heard that in the last week, that the bear market is over. Just ridiculous. The real economy, David Tepper talked to one of his friends, and his friends put out a tweet, and he was talking about how the real unemployment rate is over 20%. All the firms that hedge fund manager David Tepper, billionaire hedge fund manager, he owns the Carolina Panthers now, the NFL football team, that most of the companies that David Tepper has talked to, the senior executives, are almost out of cash and in financial trouble, and yet the stock market is rallying. So it doesn't match reality at all. Okay, back to this article. Those concerns were answered this morning when, as part of the Fed's expanded $2.3 trillion loan bailout program, the Fed announced the expansion of its primary and secondary market corporate credit facilities, which will now purchase, drum roll, junk bonds that were rated BBB- or above, the threshold for a company's debt to be considered investment grade, on March 22nd. Why March 22nd? Because Ford was downgraded on March 24th, and as a result, its bonds are surging. So let me just, I'm moving around a little bit, but I think this story is connected. on March 18th, Bloomberg put out an article by Justin Sink, and Larry Kudlow gave an interview, and I don't think there's any way Larry Kudlow would have said this in public unless President Trump and U.S. Treasury Secretary Steve Mnuchin approved it, because he would have been fired for actually saying this in public, and he still has his job. So he said almost a month ago that the U.S. federal government may actually start taking equity stakes for companies it helps. So this is similar to what happened with AIG in 2008. I was getting in an argument with a financial professional on Twitter using another fake name a few hours ago, saying AIG was a special case. They'll never do that again. And I was telling him Kudlow just said the same thing. Kudlow just said they will do it again 3 weeks ago. He was prepping people. Do you really think that Kudlow would have mentioned this in public about the U.S. government buying equity stakes? And in my educated guess, the prime companies probably are companies like Ford, because Ford is a premier American company, Boeing, those types. Those would be some of the prime candidates in my educated guess, my humble opinion. Now, who knows if the rest of the equity is wiped out, but the government actually made a lot of profit bailing out AIG, because after the stock market was manipulated higher years later, the federal government made many, many billions of dollars off their AIG shares and dumping those. So they took an enormous equity interest in AIG in the 2008 financial crisis, and I think it was like 3 or 4 years later they had finally sold all their shares, and they were at enormous profits, billions and billions of dollars. So it looks like the government is planning another scheme like that. And I do not think that Larry Kudlow would have said that in public if he had not already spoken that over with President Trump and probably also Steve Mnuchin. So they had to give him approval to say something like that. That's my opinion. Okay, let me get back to the article. Okay, in the term sheet of the revised term sheet of the secondary market corporate credit facility, the Fed now writes that, quote, to qualify as an eligible issuer, the issuer must satisfy the following conditions. The issuer was rated at least BBB minus or below that as of March or above that as of March 22nd, 2020 by a major nationally recognized statistical rating organization. If rated by a major national NRSRO, that's the abbreviation, the issuer must be rated, I'm not going to say that 3 times fast, must be rated at least BBB minus by 2 or more ratings agencies on March 22nd. An issuer that was rated at least BBB minus but was subsequently downgraded must be rated at least BB minus as of the date on which the facility makes a purchase. If rated by multiple ratings agencies, such an issuer must be rated at least BB minus by 2 or more ratings agencies at the time the facility makes a purchase. The same logic applies to Fed purchases in the primary market. Going forward, the Fed's primary corporate credit facility were a Federal Reserve, an illegal Federal Reserve, because they're violating the Federal Reserve Act, according to Danielle DiMartino Booth, because the Fed is not legally allowed, according to the Federal Reserve Act, to buy any type of corporate bond. So they created a dummy corporation, a special purpose vehicle. So they will purchase qualifying bonds, and Congress, of course, had no problems with this, because normally to buy stuff like this, they would have had to go to Congress and get Congress's approval. Where a Federal Reserve SPV or special purpose vehicle will purchase qualifying bonds as a sole investor in a bond issuance and purchase portions of syndicated loans or bonds at issuance. It will also include junk bonds. But wait, there's more. In addition to buying the investment grade exchange traded fund LQD, which a bunch of my professional money manager friends and hedge fund manager friends were buying puts in for over a year now and were heavily short. They had enormous short positions in those for LQD, and the Fed screwed them over. Well, they did temporarily make large profits, but then the Fed screwed them over too. We noted 2 weeks ago, again, another rules change, right? Stop me if you haven't heard this one. Going forward, the Fed will also be buying junk bond ETFs, such as JNK. My God, they are buying junk bond ETFs. This is as bad as Japan. Japan, the Bank of Japan, for those of you who think that the Federal Reserve can profit off of all this, the Bank of Japan lost 3 trillion yen on its equity, on its stock market ETF purchases, on its Japanese stock market ETF purchases. Now, I don't know if they made profits on anything else, but I know that story came out in the last month or so that they lost a lot of money on Japanese stock market exchange traded fund purchases. Okay, the facility also may purchase U.S. listed exchange-traded funds whose investment objective, so this just proves full Japanification. They're going to yield curve control. They're doing a lot of the same things that the Bank of Japan has been doing for a long time with very little success in Japan. With their asset prices anyway. May also purchase U.S. listed ETFs whose investment objective is to provide broad exposure to the market for U.S. corporate bonds. The preponderance of ETF holdings will be of ETFs whose primary investment objective is exposure to U.S. investment-grade corporate bonds, and the remainder will be in ETFs whose primary investment objective is exposure to U.S. high-yield corporate bonds. Translation, by JNK, which is the junk bond ETF, with leverage, as market prices are now terminally disconnected from underlying fundamentals. A separate facility will be used by the Fed to accept highly rated bonds backed by commercial real estate loans, as well as the safest slice of instruments backed by leverage loans. Okay, let me add here, there is no such thing as the safest slice of leverage loans. Okay, there is no such thing as the Diet Coke of toxic sausage. I can't believe they're spinning this like that. My God. Finally, the Fed also laid out the type of leverage it will apply using the Treasury's equity investment as a capital base, noting that the facility will leverage the Treasury equity at 10-to-1 when acquiring corporate bonds from issuers that are investment grade at the time of purchase, and when acquiring ETFs whose primary investment objective is exposure to U.S. investment grade corporate bonds. Jim Bianco has talked about this. He said that the taxpayer is actually on the hook and the Fed is just financing it. So the taxpayer is the one who's getting screwed over the most. And anyone holding dollars long term, those are the ones who are getting screwed over. Additionally, the Fed will leverage its equity at 7-to-1 when acquiring corporate bonds from issuers that are rated below investment grade at the time of purchase and in a range of 3-to-1 and 7-to-1 depending upon risk, and when acquiring any other type of eligible asset. So normally this would bankrupt any other institution but the Fed is a central bank, and central banks don't have to worry about going bankrupt. Well, not yet anyways. Fed's expansion of facilities to encompass riskier debt, including debt issued by companies owned by private equity firms. Oh, there's the private equity bailout, because these scumbags, these sharks that fuck over pension funds have to get a bailout too, will be controversial. One investment industry insider told the Financial Times that it was tantamount to an indirect bailout of the private equity industry. Quote, if you think people were upset about bailing out banks where the CEOs were making $50 million a year, how are they going to feel about bailing out private equity firms where the CEOs make $500 million a year, said another investor. Separately, the Fed announced on Thursday that it would purchase up to $500 billion of short-term notes from states and some counties and cities in an attempt to shore up their funding because they don't have any tax revenues coming in from normal pre-coronavirus level economic activity and because the global supply chain is pretty busted. Oh, shout out to Dimitri Kofinas from Hidden Forces podcast. If he's listening, there was an absolutely fantastic interview that he released earlier today from I think the CEO of ISM about the global supply chain. That is a must listen. Really, really good. He actually has more Patreon account contributors than me. Not that many more, but more. Okay, back to the article. Okay, stop short of supporting. Okay, so the Fed for right now is only buying short-term state and county and city municipal bonds. They're not buying long-dated municipal bonds yet. Oh, they're gonna buy those eventually. They're just saying right now we won't do it. We're gonna put our foot down. We're gonna put our foot down. This is like the parents who let their little kids get away with everything, or their dog get away with everything, and then they tell them no once, and then the kid starts crying, and then finally they cave. This is the Fed, folks. Quote, to buy high-yield bonds and not longer-dated munis is not fair, said Vikram Rai, head of municipal strategy at Citigroup, who probably is longer-dated municipal bonds. The Fed's expanded effort to, it's just comical at this point, with all the people who are trading all this in the casino and still making lots of money. The Fed's expanded effort to aid the muni market was, quote, a huge disappointment, he said, adding that the central bank needed to consider buying municipal bonds with longer maturities. In short, the only asset that the Fed is now not directly buying is stocks. And here, too, it's just a matter of time before the Fed unveils it will start buying SPY, which is the S&P 500 ETF. S&P 500 stock market ETF. Also, just a matter of time probably until they start buying all the student loan debts. Because why not? They're going to buy everything but the kitchen sink. They'll buy the kitchen soup too. Okay. Let's take a look at... Oh, also I want to talk about the oil market. So oil market is already down 9%. So in spite of these oil production cuts, you know how hard it is to get all these different countries, OPEC plus, Saudis, Russia, OPEC, to all agree to cut total 10 million barrels per day? You know how hard that is? That's really hard. And in spite of that, the oil market the oil price on WTI crude still dropped another 9%. So it's already down on the oil futures, $2.33 a barrel. Not good. Maybe that's because a report just came out. It's on the front page of oilprice.com that a new analyst research report says that oil demand could fall as much as 27 million barrels per day in April, which would be the largest decline, I think, in history. Insane. You have a situation now where the oil market's also looking at the jobless claims. The oil market's seeing that there's not a lot of economic activity. The jobless claims, the oil market's worried about that. The oil market's worried about oil demand and gasoline demand and jet fuel demand all collapsing still. I was during the week I saw one of the airlines release that their air traffic was down 94%. 94%. But please tell me how oil is guaranteed to rally immediately. For now, hopefully things will change in the future. For now, the demand side of oil is broken. And it's going to get worse. It's a falling knife. Okay, now I will take a look at the super chats. Okay, thank you for the super chat, Kyle Lindgren. Much appreciated. How much longer will the endless printing of money drive up gold? How much longer will the endless printing of money will drive gold and silver up? It could go up endlessly. I think it will stop at some point if governments start to put windfall profits tax on owners of gold or silver or Bitcoin, because I think that could also happen with crypto. Governments seem to be interested in government cryptocurrency in a cashless society for tracking and taxing transactions. You know, as long as the central bank balance sheets are going to go crazy, the next leg, the next phase of the gold and silver bull market is going to go a lot higher. Almost 400 people watching and no likes. Well, some likes, but not even 100 likes. Please smash the like button. Thank you very much. A trillion here, a trillion there. Pretty soon you're talking about real currency, not money. $1 trillion is not currency, is not money. It's currency. It's monopoly money at this point. The how quickly they're giving out bailouts and printing it's monopoly money. If they waive student loan debt, you're looking. I think the timeline for $2,000 an ounce gold has moved up even more. I would be surprised if gold is not at $2,000 an ounce in 6 months or less, but we'll see. At the pace the Fed's balance sheet is going, the Fed's balance sheet's going to be in a couple weeks is going to be over $7 trillion. It's growing at almost $300 billion a week. It grew $271 billion this past week, $600 billion I think the week before. It's insane. So Kyle, you tell me when the central bankers and governments are going to cut spending and behave, and then I'll tell you when the gold and silver bull market are going to end. JB says, who gives me a lot of super chats, he says that's why General Electric kept a 1-cent dividend to keep it in pension fund portfolios. Exactly. So stock mutual funds and pension funds keep the stock. Yep, because they have a dividend. If they have no dividend, they dump it. Okay, Chicky for Noobs, thank you for the super chat. Is it likely for the Dow to keep going up with all the money printing? No, because it's likely it's going to go up and down. It's going to be very volatile. And history is our guide, because look at what happened to stocks from 1929 to 1937. There was bear market rallies. There was pretty large bull runs in stocks, and then there was other crashes. So after the October 1929 crash, take a look at the stock chart, and then also look at the stock market in the 70s. So for a while, and those are probably the two best historical comparisons to what's going on now. It's a combination of 1929 and the years that followed, so 1929 to 1937, and then also the 1970s stagflation. So what's happening now is a combination of those two things, plus you throw the coronavirus, enormous monkey wrench into the global supply chain and the oil market and traveling, and that's why you have the dollar shortage, because the dollar standard that we're on, the dollars are not flowing from American tourists and American consumers and American companies out of the country to the foreign companies that need them. So they're defaulting very rapidly, I would imagine, on their dollar-denominated debt and their derivatives positions that the foreign banks have, the forward dollar swaps, and these governments have them too. Like China and Brazil, they have massive amounts of forward dollar swaps. That would be my educated guess why the dollar swap lines were opened. And then they added the other central banks like Brazil and others there, because the default rates were enormous. So to answer your question, no, it's not guaranteed the Dow is going to 30,000, 40,000, 50,000, 60,000. There's going to be a lot of volatility. You could have for example, you could have a rally for another couple weeks, and then really bad jobs data, and then another second out. The data coming out now is that there's a second wave in China, Guangzhou, and some other cities. It's all over a lot of the really credible news agencies that are covering China well. So there's a ton of information out there that there's a second wave in China. Now, China is trying to restart, and some Chinese cities, there is more economic activity, more driving, and more pollution, and more electricity running. The pollution and the electricity are indicators that the factories are running. However, China's economy is mostly an export economy, and the European consumer and the American consumer are not European Union consumer are not exactly doing very well. So China's hurting really bad, plus they have a lot of dollar-denominated debt too. Thank you for the super chat, Andrew. I appreciate it. VLCCs, like DHT. What's a VLCC? I normally don't speak in a lot of abbreviations. The kitchen soup is a joke, Kay. Sorry, JB, I don't know what a VLCC is. Okay, super chat from Martin. Thank you, Martin. Do you know why Luke Roman maintains that stock market appreciation is a matter of national security? Do I agree? No, I don't think it's national security. I think it just blows a hole in the government budget. They need the capital gains tax revenues. Now, a lot of Luke's ideas are pretty wacky. Luke is way too bullish on China. I don't agree with a lot of what Luke says. He's way too optimistic and bullish about China. He will not admit they have any problems. The last time I spoke to him. So no, I don't agree with Luke. I don't agree with most of what Luke says. Oh, okay. You're talking about the very large crude carriers. Okay, let me go back to your question now. Okay, so very large crude carriers like DHT are making a fortune right now. What happens to them after the world economy normalizes, in your opinion? JB, if you look at their financial statements for the oil tankers, these are the management teams of all these companies are extremely horrible. In different market conditions with different oil prices, where there was a lot of demand for oil in other countries, the oil tankers still couldn't make money. So over the long term, I would not bet on any of these firms. They are extremely poorly run. You can tell in the financial statements, in the income statements, the balance sheets, and the statement of cash flows that these management teams all suck. So even in good market conditions, maybe with double, I've heard the amount that these oil tankers can charge to store now is double. Based on what I'm seeing in the financial statements for these oil tanker companies, the management teams are going to screw it up at some point. So these are just a trade to me, maybe for 6 months, maybe for a year, maybe for 18 months, maybe for 2 years. I would not hold these oil tanker stocks. These are extremely poorly run businesses. Some of those oil tanker stocks, when I was looking at the financials, there was quite a few of them that have had no profits whatsoever in any market condition for the last 4 years. Kyle asks, thank you for the super chat. Do I think cryptocurrency will move higher also with gold and silver? It's tough to say. I mean, crypto's manipulated too with the futures contracts. I think crypto could pop. It might, for a short period of time, outperform gold and silver. Would I put most of my money in Bitcoin or crypto? Absolutely not. Would I speculate on cryptocurrency or trade it? If I wanted to make some profits off the volatility, maybe. I think there's opportunities there, in my opinion. No, I would not be all in on crypto. Gold and silver are way safer. It's easier for me to analyze a company with their financial statements and free cash flow and revenue growth and margins. It's much easier for me to do that. So I think crypto could go higher, but also I think governments want government crypto. And Bitcoin and Ethereum and the other cryptocurrencies do not fit in with government cashless society. So if governments are serious about that, they could make you a criminal or force you to sell. They can make you a criminal in your own country for owning cryptocurrency. See, this is what a lot of the people in the gold and silver community and the cryptocurrency community don't think about, is what happens when government changes the rules and either puts in a windfall profits tax or forces you to sell. Look what FDR did in 1934 with gold. They can do the same thing with crypto. They can do the same thing with gold and silver now. This is why I'm not all in on anything. Okay, another super chat after this crisis. Oh, from JB. And a lot of messages coming in here. After this crisis and my predicted oil price spikes, we will have an oil price spike at some point. You tell me when normal pre-coronavirus economic activity levels comes back though. That's the question. Is it 6 months? Is it a year? Is it 18 months? Is it 2 years? It's tough to say right now. I would not be long anything oil right now. I know lots of people are buying tanker stocks and people are buying the dip. I mean, look at all the bad news. ExxonMobil had more credit ratings downgrades this week. Canadian oil companies, looks like bankruptcies there. It just looks like a mess. It's a falling knife still in oil. Okay, would this be priming up for one of the longest and largest contangos in oil history? If you want to use leverage with oil futures contracts, that's your business. If you can hold the oil futures contracts and roll them over, you could potentially make a lot of profits with those. The problem is if you mistime the oil futures contracts and the price goes lower, you're going to get big margin calls. And there was lots of people who were buying oil futures contracts when oil was at 30. Oil would not go below 30. I heard lots of people say that. Oil would not go below 25. I heard lots of professional traders say that. The new one is, the new number now is 20. I'm hearing lots of people say oil will not go below 20. Okay, so you're going to take out futures contracts on margin? Again, I'm not advising anyone to do this at all. Think this is extremely dangerous, but if you're a hedge fund manager playing with other people's money, you're welcome to do this. I warn you not to, but you're welcome to do this. If you use paper futures contracts and you screw up the timing, like if you bought paper oil futures contracts at 35 or 30 and it went down, you're going to get big margin calls. So your contango trade is going to take a long time to play out. In the meantime, you're going to get killed bad on margin calls. You're going to get stopped unless you can afford to pay the margin to pay off the debt. You're going to get stopped out of your trade. I would not rather do that. There are better ideas for the rally in oil that are safer, although not as high returns probably, in an article I just put out behind the paywall on for my patrons. There are safer ways to play oil. Oh, you never use margin on your futures contracts? You're a small minority. Most of the people I know who use futures contracts use lots of margin. Okay, I think there's a couple more super chats. I'll get to those. Jonathan says, thanks for the new oil exchange traded fund article. Also, why there's problems with USO. I now have 2 articles in the last 10 days about USO, the problems with it. There's a lot of problems. It's almost as bad as GLD and SLV. That's how bad USO is. Given the recent gold miner stocks, price action is now a good time to load the boat on gold miner stocks. Jonathan, in my opinion, all gold miner stocks are not equal. So unless you're going to buy gold mining stock ETFs, like a GOAU, G-O-A-U, or a Sprott, the Sprott Gold Miners one, there's 2 of them. There's the regular miner one and then the juniors. So there's SGDM and then SGDJ. For the juniors, you really need to look at individual company balance sheets. So if, for example, if it's a gold miner and they own 1 gold mine and the government that they're operating the mine in ordered the mine shut down for 2 weeks, but the miner doesn't have much cash on the balance sheet, the miner has a lot of debt, and the miner is struggling to afford to pay care and maintenance on the mine, because care and maintenance on the mine, if you're not familiar, is not cheap, then that could be risky. So unless the mine restarts, the miners need cash flow. So if the miner only owns 1 or 2 mines and 1 or 2 of those mines or all their mines are shut down temporarily, maybe no coronavirus there, but the government still ordered them as a precaution to shut down. So that's my point. My point is, if you buy individual mining stocks, either you know how to look at the financial statements with cash on the balance sheet and how much debt the miner has when it's due, if the mines are shut down, what the costs of the miner are. I've been very big on costs. Okay, well, I think that's it for tonight. I want to thank everyone for listening. Thank you very much to my Patreon account contributors. It's almost 700 now. It's really, really good. Thank you so much. I've been working very hard to provide a lot of content, research, financial education, and analysis behind the paywall there. Also on the free podcast, but there's even more behind the paywall. There's a lot of well-researched articles, audio podcasts, and technical analysis charts behind the paywall. For starting as low as $5 a month. Can't top that anywhere. I don't know anyone else that has the content I have for $5 a month. Normally people charge it's a lot more than that. It's like $400 a year, $500 a year normally for the similar services. And thank you very much to my monthly PayPal contributors, and people tip me once in a while. If you want to save on fees, through my website, I also take one-time PayPal donations, and I do take some crypto tips. People have tipped me some crypto once in a while. Okay, everyone. Markets are not open tomorrow, so I am working on some interviews. We'll see what happens. I have another in-depth article here that is called The Day the Fed Nationalized the Bond Market, the complete summary of everything the Fed did today. So that will be in the information and description section if you want to read more on that. But this stock market rally, totally divorced from reality. The reality of the U.S. economy with the jobless rates, the oil prices, oil demand collapsing, there's not bullish news. So this is central bank balance sheet expansion, and also the Fed buying up, the debt problems with the corporate bonds and the junk debt, and the markets reacting to the Fed potentially cleaning up the balance sheets of some of these companies. That's what the market's reacting to. Now you're going to see the CNBC and Bloomberg people are going to march on any idiot they can get in an expensive suit or expensive dress who will tell you that there's fundamental justifications in the real economy why the stock market is rallying. And I will tell you, nope. Definitely not. Look, if the Fed's balance sheet goes to 10 trillion, 12 trillion, 15 trillion, there's going to be a lot of volatility in the stock market. The stock market will probably end up higher, but then the value of the dollar, the purchasing power will be down a lot. Same with all these other currencies. All the other currencies suck too. I think that's the point that most people in the gold community miss, is they tend to be dollar collapse people, but all these currencies, all these central banks and governments are all doing the same stupid stuff. Whether it's China, the European Central Bank, Japan, they're all doing really, really dumb stuff. Even Canada just announced QE. So that was to buy up the bad assets off their bank balance sheets. So they nationalized a bad bank. So even Canada did QE for the first time, I believe.